think a lot of the beat is actually coming from higher rates because what we have seen in Singapore banks over years, last 20 years, let's say, that they have one of the best rate transmission mechanism at two levels. One is from Fed rates to Singapore dollar rates, and then from Singapore interbank rates to the actual lending rates within the bank books. And that's exactly what has driven a bulk of beat year to date. And definitely, Singapore reopening has helped a lot at two levels. One, credit card spend has gone up, some of the fee income has gone up. And the more important bit is asset quality. We have started getting a lot of comfort on the existing asset quality in NPL book across Singapore banks. So that is closely linked to reopening, whereas at the operating profit level, significant upside is driven by higher rates.
Now, as we talk about rates, we had the MAS with a surprise move in recent weeks to tackle inflation. This should be beneficial to NIMs and net interest margin. How long or how far do you expect this to run for?
So yes, MAS has moved, and that does have an impact in terms of the Fed rate transmission into Singapore dollar rate. But the much broader narrative, which has been the case year to date and probably a bit more to run, is the extent of Fed rate hike. When we started the year, that was our base case that Singapore banks provide one of the best hedges against larger than expected Fed rate hike in course of the year. And that's exactly what we got, that we ended up getting much higher hikes, much higher interbank rates, and much higher margins. And what is very interesting, Emily, is not only the second quarter margins were high, but all the three banks are guiding for consistent net interest margin expansion in second half of the year. And a lot of it is partly because Fed has surprised compared to expectations 6 months ago, let's say, and that is flowing through the P&L. That still remains in our mind the more dominant thematic for Singapore banks.